Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah, and our guest today is Indranil Sengupta. Lots has happened on the fixed income markets and the space, both globally and locally, in the last month and a half. And it's a delight to be talking to him to understand his perspective. Indranil, great having you. Thanks for taking the time out.
Thank you. My pleasure.
Can I start with the global, even though your note was, of course, talking about how you're becoming more bullish on the Indian bonds. But can I just start off with the global factors, Indranil? Higher for longer, even if it means that there are no further rate increases, does that augur, or what is the kind of implication that has for risk assets worldwide, in particularly emerging market bonds and equities?
So I think that the Fed obviously is now getting repriced in the US bond markets. And, I never believed, for example, that the Fed would cut in June, July of 2023, as the US money markets were pricing. But now that, a lot of the repricing is done, I presume that, markets will now stabilize at some stage and, in a range, of course, and then look to cuts, as and when they happen. I mean, of course, the Fed may hike once more, but then somewhere down the line, then the markets will begin to price in cuts. Now, if you see, it looks like, US inflation, headline and core, are stuck somewhere in the 3s now. And the Fed is in the 5s. So, 200 basis points is a very high real policy rate, even by US standards. So I think that, earlier the markets were underpricing the Fed. Now, to some extent, there is a risk that they are overpricing the Fed. So I think that as we go along, we will find that the dollar will begin to, soften as, there is a sense that the Fed is done, or at least the Fed has paused. And that will give headroom to emerging markets to, see lower rates.
So how does that therefore impact, like you said, it gives a bit of a headroom to emerging markets, but how does it play into India's and RBI's hands? Could idiosyncratic factors like supply side, oil issues, or otherwise force the RBI's hand to not do what it ordinarily would in the case of Fed doing what you are saying it would?
So I will look at it in 3 ways. Number one, I think that if the dollar were to soften, then the primary reason why the RBI is sitting at 6.5, which is the Fed, will go away. So, there's no reason for the RBI to sit at 6.5 in a country where, inflation is averaging around 5.5 in this sort of a global environment. And number two, if you look at flows in India, typically higher rates tend to depreciate the rupee and lower rates tend to appreciate the rupee, which is, what Governor Subbarao once called the Indian exceptionalism. So what typically happens is that in India, you have foreign equity FIIs holding $650 billion. Local FIIs holding, $30-40 billion. Debt FIIs holding $30-40 billion. So the movements by the equity FIIs tend to dominate the currency, unlike in many other emerging markets where maybe the two are like 50-50. So if you cut rates, FIIs chasing, equity FIIs chasing growth come in, the currency appreciates, and that brings in debt FIIs because they want capital gains, and vice versa. So therefore, I will say that, if you were to lower rates, I think that will actually go and support the rupee. Now, let's come to the case of oil. Now, sure, if oil prices go up, there is always the risk that, this will lead to domestic inflation. The government may not immediately pass on because, there's obviously an election nearing, but then sooner or later, There's a limit to how much you can, bear from the fisc. But at the same time, if the RBI has to sell FX to fund the oil bill, it will have to do that much larger OMO to provide liquidity. So, that also will be supportive of bonds. So, if you stress test the variety of factors, you find that the risk reward is now in favor of bonds than against, given the sell-off that we have seen.
Got it. There is also this theory that independent of what kind of flows start coming in from June because of the India's inclusion in the JP Morgan Global Emerging Market Bond Index, the bond yields will not wait for the event to happen, but might be start discounting it in the first half of the next calendar as well. Is that also supportive, if you will, of the bond markets?
See, that's supportive in sentiment, but not in numbers. Because, what will happen is that once the debt FIIs come in with the FX, the RBIs will buy the FX and give them rupees to buy bonds. And therefore, the RBI will cut down its own open market operations, OMO purchases. So debt FIIs coming in will not add to the demand in the GSEC market. It will just substitute the demand from RBI with the demand from debt FIIs. But yes, in sentimental, in terms of sentiment, it's a positive.
The event in itself, Indranil, there was a lot of fanfare around it because it's a long anticipated one. There are people or certain quarters who tell me that this is maybe not as big a positive as it is a cushion on the downside should events turn worse for the rupee. What is your thought on India's inclusion there in JPM currently and potentially some other bond indices at some point of time on the back of this happening?
I think a lot of this would have been true had this happened in 2013. In 2013, we were talking of 200, about 200 billion of AUM, tied to this index. And our FX reserves were about 250 billion to 300 billion. So 20 billion coming in 2013 was a lot of money, almost 10% of FX reserves. Today, our FX reserves are 650, 600, 620. So 20 billion today is, really very small, 2-3%. So I don't think it'll matter much either way. And in fact, FPI investments in debt in the past have been much higher, even without this 20 billion. That is number one. And secondly, I think that, I understand that a lot of the funds that track this index are also active funds. So, it's not mandatory that you have to go, exactly mirror the index. You can go over and below. I also think that, we may go and list in other indices, but the reason why we wanted to get in here is that this was the bigger one. So I am not so sure whether, the others are going to be bigger. And I also think that some of it may be added, it may not be additive in the sense that, if another index says you should have $10 billion in India and you already have 20, you don't have to shift.
Got it. Okay, now last couple of questions, and I'm coming to the crux of what happens from our central bank's perspective. And you briefly mentioned it at the start of this conversation, but I'm trying to kind of extrapolate this conversation now. In your note, I read that should the Fed be on a pause mode, then it gives the room or elbow room to the Reserve Bank to make a meaningful cut, if I'm not wrong, in starting the month of December itself. One, could you elaborate a bit on that? And two, are you a contrarian here, Indranil? Do you reckon that the street largely is still pricing in rate cuts are further down the line in 2024? Or do you reckon that mostly this will be the most probable scenario of December seeing the first of the cuts?
So, let me put forth my argument that, inflation is going to be around 5%, right? I mean, it's going to fall this evening. And you are at 6.5%. Your core inflation is already at 5%. If you look 1 year out, the RBI itself is projecting 4.5% inflation. So your real rate is at least 1.5% to 2%. So, should you be sitting at a real rate this high at a time when there's so much of uncertainty, when the chances are that US is going to slow down? Therefore, I think that while I was, projecting higher RBI rates when the Fed was hiking, now that the Fed is done or looks to be close to done, I think that the RBI will want to unwind the tightening. Now, of course, the Fed may hike once, that may force the RBI to hike once more because, the differential is already just 100 basis points. But I'm sure that once the Fed stops, maybe again by February, the RBI will want to roll back because there are two factors, right? I mean, there's the Fed and there's domestic inflation. Domestic inflation does not warrant, a policy rate of 6.5% for sure. So once the Fed constraint goes away, I'm sure that, the RBI will also begin to cut.
You would reckon that some of the domestic inflationary factors, crude notwithstanding, but the domestic factors are also transient in nature and difficult to predict whether they sustain over a period of time?
See, I think you cannot make monetary policy depending on the price of vegetables and so on, because these go up, these come down. Like, we had said El Nino will lead to 200 basis point jump in food prices. It actually led to a jump of 260 basis points. I think the government did a good job of, cooling food prices through the various measures they took. And, if someone had asked you 2 months ago that inflation will fall this sharply, you would have said, can that really happen? Because these are very, very volatile. Ultimately, you have to see core. Core is now down to 5%. So from that perspective, I think that, the RBI also will actually see that rather than the overall, because that is why, this is something the governor said, this is something the finance minister also said, that we cannot really, we are not looking at RBI monetary policy to combat what is essentially a rain shock.
Okay, got it. Indranil, and hence viewers, Indranil Sengupta and team have turned bullish on bonds, and that note lays it out beautifully. So we'll kind of capture all of that in the story that we do for this interview as well. I have one final question, Indranil. I'm changing tracks here, but it's a point that was raised and debated by a couple of guests in the last 1 month, and I thought I'll ask you, and that's around the belief around what could happen to India's current account deficit numbers over the course of the next 2 years, and what might actually be desirable. Now, are you in the camp which believes that we might be headed towards CAD neutrality over the course of the next 24 months? Why or why not? Part one. And part two, is that desirable, or would you rather that India as a growth country remain a current account deficit up to a particular extent and keeps on funding growth which might be necessary?
So I certainly think India should run a current account deficit and fund growth. That is number one. Number two, you see, there are, I know that the argument that is made is based on, higher services inflows. But when a economy recovers fully, then import demand also rises very sharply. So, you cannot take the import demand of today and take the services flows and look at CAD, because, of course, we are in a shallow recovery in India. Globally, growth is also very suspect. But I am guessing 2 years down the line, 3 years down the line, the cycle will have meaningfully turned. All cycles, you have up cycles and down cycles. So when there is a up cycle which returns in growth terms, import demand will also go up.
Got it. Okay. Indranil, such a pleasure talking to you. Thank you for taking the time out and speaking to us, and look forward to have you more often on our platform.
Thank you.
Thank you. The pleasure was ours, viewers. Thanks for tuning in.